Long straddles and strangles are speculative strategies that can be used to profit off of a large price move in either direction. Well, there are some things you should understand about straddles and strangles before you use them. Straddles can be used when an investor is expecting a stock to make a major move, but is unsure about the way the move may go. Earnings announcements, corporate actions, court decisions, political or economic announcements, or even consolidation pattern breakouts are all examples of situations that may be appropriate for a straddle trade. A traditional long straddle is constructed by purchasing an at-the-money call and an at-the-money put with the same expiration. Well, typically, an investor would purchase options that expire shortly after the expected stock move. For example, if a stock had an earnings announcement on a Wednesday and an investor wanted to trade a straddle based on that event, the investor would probably use options expiring the Friday immediately after earnings. Since options price in expected moves in the market, it follows that an at-the-money straddle prices in the average expected move of a stock between now and the expiration date of the straddle. For example, in this trade, the stock is trading for just over $468. The total cost of the straddle is $10.64. That means the market has priced in approximately a $10.50 move between now and when those options expire. To put it another way, the price of the straddle in this example implies an approximate expected trading range between $457.50 and $478.78. For a straddle trade to be profitable, the stock needs to move outside the range that the straddle has priced in. In this trade example, the stock needs to be above $478.78 or below $457.50 at expiration in order to profit. Statistically, straddle trades lose more often than they win because the only way for them to be profitable is for the stock to move more than the market has priced into the options. But a straddle trade can have large profits when it does work, and it's possible for one winning trade to profit more than several losing trades. For example, this stock was trading for just over $138 the day before earnings. The at-the-money straddle was trading for $8.75 per share. The break-even prices of the straddle were $146.75 and $129.25. The day after earnings, the stock jumped to more than $156. The straddle on that day was worth $18.05 per share. That's over a 100% profit in one day. This is an example of a successful straddle, but keep in mind that straddles are statistically likely to lose more often than they win. Traditional management rules for a straddle trade are pretty simple. Exit the trade after the expected volatility event has passed. The maximum loss in a straddle is the total cost of the trade. It's impossible to know the maximum profit on a straddle because there's unlimited profit potential on the call side and large potential profit on the put side. In addition, it's common for implied volatility levels to change dramatically after a large event, and that could impact the value of a straddle as well. So rather than set a profit or loss target, it's a good idea to position size for maximum loss and exit the trade quickly after the expected event or movement has passed. Traditionally, straddles are placed around an event. And so once the event is over, the reason for being in the trade is over as well. A strangle trade is similar to a straddle, but instead of buying at-the-money options, the call and put are both out of the money. And typically they're going to be equidistant out of the money. For example, a $5 out-of-the-money call and a $5 out-of-the-money put. Now, strangles are cheaper than straddles, but they also have a lower probability of success because the stock needs to move further to break even. Straddles and strangles are speculative strategies, and they can be used to profit off of a large move in either direction. practice trading them in a virtual account and see if they're right for you.